Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Fastenal stock so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 33 billion market cap. They're trading at $57 a share, and they have 571 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They do have positive free cash flow each year. It goes from 900 million to 600 million to 770 million to its highest ever, over 1 billion in the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's really consistent, going up steadily each year from 859 million to 1.1 billion. Revenue is a sales for the company, and that also goes up each year from 5.6 billion to 7.2 billion. So they have a nice steady growth. Sometimes when a company grows too quickly, things go wrong and they run into a lot of problems. Nice steady growth tends to be the best way to go. Unless you're a brilliant businessman like Steve Jobs, then you can scale and grow at a crazy pace. But most people don't know how to do it. So it's better to grow steadily and small, little by little each year till you get really big. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 31 billion. We discounted those numbers back to today's weighted average cost of capital. We get a value of the company of $26 billion. We divide that by 571 million shares. And we get a calculated stock price of $46. They're trading at $57, so they're trading at a 25% discount. It's a sell according to the model. Just because I say a company is overvalued doesn't mean the stock can't go up. Momentum moves stocks. When other people are buying stocks, especially big investors like Warren Buffett or Cathie Wood, or a big bank like JP Morgan or Goldman Sachs, then other people jump on the bandwagon. Eventually, when the stock gets too high, it does regress. I think over time this stock will go up, but it will have its dips because it does seem like it's overvalued. But there's no reason the stock can't go up to $100. But once it hits a peak, it's gonna regress down to maybe 70 or 80 and trade sideways for several years, then have another big bull run, regress a bit, and then rinse and repeat. There are 17 companies in the same industry as Fast, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend a lot more than the median and average in CapEx, 160 million. CapEx is the investments in property, plant, and equipment. They have a really low debt to equity ratio. They don't have much debt. For every dollar of equity, they only have 20 cents of debt. They pay a really nice dividend, 2.3%, much higher than the median and average. They generate a good amount of free cash flow, over 1 billion. They rank third in market cap. This is a mistake on Ferguson. It should be 33 billion market cap. I just noticed this now. The website I pulled it from must have had the wrong info. All their price multiples are worse than the median. And the reason they're worse is because the company is growing, so the market cap is going up at a pretty quick rate. So the price multiples don't look so attractive. They generate a good amount of revenue, more than the median average, but their 5-year annual revenue growth rate is only 10%, which is lower than the median average. Look at Distribution Solutions, 34%. Let's look at their earnings release. The company just released their earnings the other day. They missed analyst expectations on revenue and earnings. Here's a summary of their results. For the second quarter, revenue of 1.9 billion, up from the second quarter of 2022 from 1.8 billion, up 5.9%. This is for the 3 months ending 6/30/2023. Gross profit of 857 million, up 3.6%. So their gross profit is up less than their revenue, so their gross margins are down. Their gross margins are 45.5%. Last year, 46.5%. Operating and administrative expenses, 460 million, up from 444 million. As a percent of sales, operating expenses are 24.6%, down from 25%. Their operating income, 394 million, up from 383 million. Their operating margins, 21%, down from last year of 21.6%. That's not good because when revenue goes up, you would expect margins to also go up. EBIT, 392 million. Last year, 381 million, up 3%. So their EBIT margins are down. They're 20.9% in this quarter. Net earnings $298 million, up from $287 million. So their earnings per share are up from 50 cents to 52 cents. Let's see what they say about their sales. Sales increased $105 million or 5.9%. We experienced higher unit sales in the second quarter of 2023 that contributed to the increase in net sales in the period. This was due to our growth at our on-site locations, mainly those open in the last 2 years, which more than offset lower revenues in construction and reseller end markets related to the execution of our go-to-market branch strategy. From a product standpoint, we have 3 categories: fasteners, safety supplies, and other product lines. Fasteners are things like screws, bolts, nuts. Other product lines includes 8 product categories such as tools, janitorial supplies, and cutting tools. They talk about growth drivers. We signed 86 new on-site locations in the second quarter, resulting in 175 new on-site locations. And they had 1,728 active sites on June 30th. That's an increase of 15% from June 30th, 2022. FMI Technology is Fast Stock. That's their scan stocking locations. Fast Bin, infrared RFID, and scaled bins. RFID is radio frequency identification. And also Fast Vend for vending devices. 6,794 signings in Fast Bin and Fast Vend. That's a 24% increase from last year. MEUs is machine equivalent unit. That's equivalent to 106 signings per day. In the trailing 6 months, it's 99. So you can see they're signing a lot more this quarter than prior quarters. Fast Bin and Fast Vend installations is 107,000. That's up 11%. In this quarter, they had 1.9 billion of sales. 238 million of that is from Fast Stock, 520 million from Fast Bin and Fast Vend. So 40% of their sales, 39.8%, is from FMI devices. Let's read about their balance sheet and cash flow. We produced operating cash flow of 302 million in the second quarter, up 100% from last year. So it was about 150 million last year if it went up 100%. The improvement in operating cash flow reflects working capital being a reduced use of cash in the second quarter of 2023. So for example, if you don't buy much inventory in this quarter, you use the inventory that's already on your balance sheet, that can really benefit your cash flow. Earnings are just one way to benefit cash flow. The other way is to use working capital. Working capital is current assets minus current liabilities. Ways to improve cash flow in the current quarter is to use accounts payable, meaning buy on credit, not use accounts receivables. Even better is to get money from people who owe from past receivables. And they talk about it right down here. I didn't even see this. Accounts receivables increased 68 million in the trailing 12 months. Inventory decreased 100 million. It went from 1.66 billion to 1.56 billion. When you decrease inventory, that's a cash inflow. When you increase inventory, it's a cash outflow. And accounts payable went down. That's a cash outflow. When you decrease accounts payable, that means you had to pay back someone you owed. So it's a cash outflow. But when you increase accounts payable, that means you're buying on credit. It's a cash inflow. I hope that doesn't sound too confusing. Here's their balance sheet. Current assets of 3.1 billion. Current liabilities of 740 million. So their current assets are much higher than their current liabilities. A really good current ratio. Almost too high. 240 million of cash, up 13 million from last year. 1.2 billion of accounts receivables, 1.6 billion of inventory. Accounts receivables went up, inventory went down. 1 billion of PP&A, 260 million of operating leases, right of use assets. These are assets owned by another company that they lease. Total assets 4.6 billion, pretty similar to last year. They owe 150 million on the current portion of debt. Last year was 200 million. Accounts payable of 260 million. Accrued expenses 229 million. These are expenses the company has incurred but has not paid it yet. For example, bonuses for its employees. They owe 200 million of long-term debt. This is debt that's owed beyond 1 year. The debt due within 1 year is up here, 150 million. That 200 million is down from 350 million. 173 million of operating leases, down from 155 million. Deferred income taxes. These are taxes the company will eventually owe but are not due yet. Let's look at their equity section. They raised $26 million from selling stock, $20 million plus $5.7 million, and they profited $3.4 billion from running their business. Retained earnings is the sum of all their prior net incomes minus the sum of the dividends they paid out. So really profitable business. Revenue of $1.9 billion, up from $1.8 billion. For the past 2 quarters, their revenue is $3.7 billion, up from $3.5 billion. Gross profit $857 million. Operating income $395 million. Both numbers are up from last year. Their net earnings are $300 million, up from $287 million. EPS of 52 cents, up from 50 cents. They're buying back lots of stock. They had $575 million last year. Now they have $571 million. So they pay a nice dividend and they buy back stock. What else can you ask for? Let's look at their statement of cash flows. Their operating cash flow went up from $150 million to $300 million. It doubled. Their net income is pretty much the same in both time frames. So why did their operating earnings double? It's because of inventory. Last year, they bought a lot of inventory that had a cash outflow of $74 million. This quarter, they used a lot of that inventory. So it was a cash inflow. That inventory was sitting on their balance sheet, sitting in their warehouse. So they used it this period. That's a swing of $160 million from last year to this year. So they improved $160 million just in inventory. That's pretty much the difference between last year's cash flows and this year. Let's look at their investing section. Last year they spent $48 million in PP&E. This year $55 million. Let's look at their financing. They added $400 million of debt. They paid back $455 million of debt. They paid $200 million in dividends. So they had a cash outflow of $240 million in their financing section. This quarter they didn't buy back any common stock, which is interesting because last year they bought back $49 million. Let's look at the stock on Simply Wall Street. Its last price was $57, $33 billion market cap, up 20% in the past year, down 1% in the past week, probably due to earnings. They missed analyst targets. Let's learn about the company. They engage in the wholesale distribution of industrial and construction supplies in the US, Canada, Mexico, and internationally. It offers fasteners and related industrial and construction supplies under the Fastenal name. The company's products include threaded fasteners, bolts, nuts, screws, studs, and related washers, which are used in manufactured products and construction projects, as well as in the maintenance and repair of machines. It also offers miscellaneous supplies and hardware, including pins, machinery keys, concrete anchors, metal framing systems, wire ropes, strut products, rivets, and related accessories. The company serves the manufacturing market comprising original equipment manufacturers, maintenance, repair, and operations customers, and non-residential construction market, which includes general, electrical, plumbing, sheet metal, and road contractors. It also serves farmers, truckers, railroads, mining companies, schools, and retail trades, and oil exploration, production, and refinement companies, as well as federal, state, and local governmental entities. They were founded in 1967, 56 years ago, Lawrence Taylor, number 56, and is headquartered in Winona, Minnesota. It looks like they started trading a long time ago in 1990, and it looks like the stock pretty much only went up since the beginning. It had a pretty steady rise. It is hard to tell on this chart because it's so many years, but it kept going up and up and up and up until it hit $12 in 2008. It did regress to under $8 the following year, probably due to the Great Recession. Then it had a really nice run up to $27 in 2012. Then it dropped to $19 a few months later. Then it was up and down, pretty much trading sideways for a few years. Then it peaked again in 2020 at 35, dropping to below 20 in March 2020. Then it really ran up to over $60 by the beginning of 2022. That was its highest point ever. It did drop to below 50 at the end of 2022, but now it's coming back up. It's getting close to $60 again. In the past 5 years, the stock is doing really well. It has doubled, up 100%. The market is only up 50%, the industry 80%. But in the past 3 years, the stock is only up 30%, while its industry is up 97%. Simply Wall Street also thinks the stock is overvalued. Their valuation is $39. They say it's 48% overvalued. 13 analysts priced this stock, and the average price target is 56. They say it's 3% overvalued. The revenue forecast for the company by 2025 is $8.4 billion. And their revenue back in 2012 was $3 billion. And it steadily rises each year, breaking $4 billion in 2017, Then it kept going up. It broke $5 billion in 2019, broke $6 billion in 2021. Currently, it's a little over $7 billion, $7.2 billion in the trailing 12 months. And they always have operating cash flow. That's why they pay a nice dividend and buy back stock. They're at their highest point ever in the trailing 12 months, $1.25 billion. And they always keep a little bit of debt on their balance sheet. Nothing wrong with that because their equity keeps going up each year. Their debt to equity ratio is only 10%. $350 million of debt, $3.3 billion of equity. They pay a nice dividend, 2.4%, 67% of their earnings. Their EPS is $2. Dividend per share is $1.40. You can see they raised their dividend each year. It was 37 cents in 2012. It keeps going up. It hit $1 in 2020. And the forecast is for the dividend to be $1.56 by 2025. There's that 56 again, Lawrence Taylor, the number of years they've been active. Their dividend was 1.6% in 2012, grew to 3% in 2015. Then it was pretty steady for a bunch of years. It dropped to 2% as the stock price went up, but then the stock price came down a bit and the yield came up. So now it's getting close to 3%. The forecast is for the dividend to still be 2.7% by 2025. The CEO's salary is $700,000, total compensation $5.4 million. His tenure as CEO is 7.5 years. In the past 12 months, there's been only insider buying, no selling. That's a good sign. 80% of the companies held by institutions, 20% by the general public. Vanguard is the biggest shareholder at 12%. Their value of the company is $4 billion. They had 13,000 employees in 2012. It peaked at 22,000 in 2019. Now it's 20,600. And the ticker trades in a lot of places. The Nasdaq, London Stock Exchange, Deutsche Börse, Wiener Bourse, Mexican Bolsa, Bulgaria, and Sao Paulo Bolsa. So that's the end of the video. Let me know what you think. Give it a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking the link in the description below. Thanks for watching.